was just going to sort of do some trading here to gold prices up. I'll get back to you guys after the close, okay? Kidding. Welcome to the November 5th, 2020 edition of the Virtual Metal Investors Forum. I'm Eric Coffin, editor-publisher of the HRA Advisories. My title slide that you should be seeing right now pretty much tells you my entire viewpoint right now as far as the markets and probably the rest of the universe goes. It's a shit show, but that's actually a good thing if you're a gold stock trader. It's been a very weird month and an even weirder week, and it was very much up in the air how this would play out for the gold and silver sector and other metals. They may not play out identically. I'm going to pretty much just deal with the macro picture and how I think it's affecting the gold price and what I think is going to happen with gold and yields and a few other things going forward. But I'm gonna stay on the big picture here pretty much. Essentially, as of this minute, literally, it looks like what we're going to end up with in the U.S. is President Biden with probably a very small majority as far as the electoral count goes. Barely Democratic House. Looks like they lost a bunch of seats, and it looks like the Republicans held the Senate. Interestingly, Wall Street seems quite bullish on this outcome. There's a couple of different ways to read this. I think the big move we saw yesterday was at least partially short covering because there was a huge short position on SPOOs and especially on NASDAQ going into the election. I think there were big traders betting on a blue wave, and I think in the case of NASDAQ in particular, I think there were concerns if there was sort of a Democratic blowout, that the big tech companies were going to start seeing a lot more regulations and maybe even some breakup orders. So once the blue wave dissipated, NASDAQ just took off like a rocket the night of the election, and it's pretty much been going up since then. The other thing that I think probably makes Wall Street happy is this outcome that I just talked about above. You're essentially talking about deadlocked Washington that's probably not going to get much done. That's something that generally makes Wall Street happy because, again, with a blue wave, they were well aware part of what would have gotten done is probably some more regulation for them and certainly tax increases for a bunch of the guys running those funds was baked in the cake. Right now, I think we're still in this reflective period right after the election, since really we don't even have the final results yet. I don't know whether this is going to tail off. I think it might a little bit. I've seen a lot of articles talking about, stimulus optimism in the last couple of days, which I find absolutely bizarre because that is absolutely not what I think is going to happen. Gold at the start of the voting got caught up in some sort of risk on selling. You often get gold selling off a bit when the equities are taken off. But it seems now that things have flipped. There's a couple of reasons why I think this is happening, and that's essentially what I'm going to go into here. If you look at these charts, and I realize they're small and hard to read, I'm just putting them there so you can kind of see the shapes. There's been a pretty amazing bounce in the U.S. when it comes to essentially all of the economic indicators. These are different PMIs, orders, employment, composite indexes, and these are purchasing manager indexes. They're good. They're very good track record of tracking the good side of the economy. The service side's a little bit weaker, but not much. Surprisingly unweak given what we just went through. And the EU looks pretty much the same. I realize the EU is a bigger mess right now, but even there, the bounce was pretty impressive. Although it needs to be said that where the economies are, the G7 economies right now compared to January, would be the equivalent of the bottom of a very bad recession. It doesn't feel that way to us now because things were so ugly in Q2. We had this huge bounce that, it feels like everything's great. But the truth is we're still actually several percent below the output level we were at in January. So we're not completely out of the woods yet. There have been continued calls almost daily, really, by some politicians, but mainly by economists and by the U.S. Federal Reserve, sort of pounding the table saying, look, we're going to need another fiscal stimulus package. The one we got in the spring was great, but that's dissipated. Those payments stopped a couple of months ago. If we're going to keep this bounce from falling back again, we got to have another one. That's where we run into trouble. With the political situation shaping up now, Democrat in the White House, GOP in the Senate, the Republicans have had the same Senate majority leader for a long time. Anybody who knows anything about Mitch McConnell knows if he's facing a Democratic president, he's basically going to keep the agenda from coming up on anything. He's going to vote on absolutely nothing if he can. I expect nothing to get done in Washington. I know it's the current narrative that, yeah, this stuff probably pushes it back a little bit, but as soon as Biden gets inaugurated in January, then we're going to see the stimulus package. I hope that's the case because I actually think we do need it. I don't think it's going to happen personally. I really, excuse my French, but I would not overestimate how big a prick this guy is. Last time we had this similar situation 5-6 years ago, essentially nothing came to vote in the Senate, and I got a nasty feeling that's what's going to happen again. The other thing that, of course, is having an impact again. COVID's taking off hugely. I mean, the rates are actually climbing much faster now than they did in the spring. Now, I know what you're all going to say, and you're right. The death rates are much lower. Hospitalization rates are lower. For whatever reason, I think more young people are getting it, so it doesn't affect them as much. And I think doctors are simply getting better at treating it. That's all great, but I'm not really even thinking about I'm not thinking about the direct impacts of people getting sick. I'm thinking more about the psychological impact of people going like, man, there's a lot of people walking around with this stuff. Maybe I'm going to pull back a little bit on the restaurant dining. Maybe I don't really want to go to the mall. Regardless of what the death rates are, and we are back over 1,000 a day in the U.S., I think we'll see some slowing just based on people pulling back and getting a little bit more cautious. I'm not expecting lockdowns in North America, and it wouldn't have mattered who won the presidential election. I really don't think either side's got any interest in doing lockdowns. It just about blew the economy up in the spring. I don't see North America doing that again. I don't know what they're going to do in place of it. I mean, I guess they'll try to cajole people into wearing masks. There might be some specific, maybe they'll say we're going to close bars again or something like that. But I don't think we're going to see a stay in your house. I just don't think that's going to happen. I'm surprised it happened in Europe, to be honest, even with the numbers they have. Now, when you look at that surge happening again, you look at the fall off from the spring's fiscal stimulus, Wall Street consensus, and we're talking Wall Street here, not a liberal think tank. Wall Street's consensus is they need another $2-3 trillion stimulus package to keep the U.S. economy from decelerating right back to zero again. And again, I repeat, I do not think this is coming. So where does that get us? Well, at some point the market's going to come around to, they'll certainly come around to accepting it isn't going to be until January. I think the market's already sort of getting there a little bit. I don't think the market's come around to believing there might not be one, or at least one, of that scale, 2 or 3 trillion. I just do not think that's going to happen. I don't think Wall Street has come around to believing that yet. We'll see what happens over the next couple of months as that sinks in. And we see how Washington kind of operates during this lame duck period. So January. Now, if you look at the impact of the reflation trade, if you will, and the acceleration in the U.S. economy, you can see this. This is a 10-year bond yield chart. I use this a lot in the newsletter. The up arrow there is obviously the period just through from August up until the end of October, where the reflation, and yes, we're going to have another stimulus package. That concept really kicked in. That's when you saw basically 10-year yields, and those are multiplied basis points. So what you're like when you see a 7 there, it's actually 0.7. They're multiplied by 10 on this chart. So that's when yields, basic 10-year yields went from 0.5% up to about 8.8%, almost 9% a few days ago. That move was mainly based on the economy's accelerating. There's probably going to be another package, so the economy is just going to keep revving and revving and revving. Suddenly it fell off a cliff 2 or 3 days ago. That was the election. That, I think, was bond traders who, in my opinion, tend to be right first on this stuff. I think bond traders looked at the political situation and said, yeah, okay, forget fiscal stimulus, that's out the window. But the other side of that is you've still got the FOMC that's been yelling for this stimulus package for about 3 months now. I don't think that's going to change, and the Fed is, to some extent, to a large extent, an independent actor. And I think if they come to the conclusion they're not going to see a fiscal package, they're going to ramp up QE again. I think you'll see them ramp up QE. I think you'll see them ramp up the yield curve control. Essentially, they'll be buying bonds. Buying bonds drives the yields down. And I think part of this drop you just saw in the last 2 or 3 days is bond traders getting ahead of that. Because bond traders have done pretty well so far this year, simply getting in front of the Fed before the Fed does what it telegraphs it's going to do. Of course, that move in bond yields, the bottom of the bond yields was right about where the top, the gold price was in August. The gold price has been sort of drifting lower as those bond yields climbed. I think that was a combination of, I think it was mainly the bond yields. There was a bit of a move in the dollar, but I think the bond yields is to me is the bigger factor. I've always said that I think real yields are the most important driver. I don't think a fiscal stimulus is coming. That was also weighing on gold, but it held in around 1900, and I think we are going to see the Fed get active. It's not going to happen tomorrow. They just had an election 3 days ago. They don't know who the winner is yet. The Fed isn't going to want to step into the market 3 days after an election, but I don't think they're going to wait that long. If they decide the fiscal's not coming, I think you'll start seeing the QE, and I think the combination of those two factors is part of what's given gold the bounce, especially in the last couple of days. I hope you noticed that I ordered a $50 gold price jump because it's a middle investor farm day today. You're welcome. The next thing I want to show you, and this is a chart I actually used at the last MIF. It's kind of an interesting chart that's put together by BCA Research, which is a Canadian research outfit, very well-respected one. They have this long-term 15-year chart, and what it is, it's a comparison of the U.S. dollar index, and this is the broad-weighted index. You'll see another chart in a minute that's a different dollar index, is the one people usually look at. This is sort of the Bloomberg broad trade-weighted index. It compares it to what they call their global political uncertainty, and this is their own proprietary index. And essentially, they're looking at how much uncertainty is there in U.S. policy compared to offshore political policy. As it happens in the last little while, there's obviously been a huge shift where previously it looked like we all knew what was going to happen in the U.S. and things were a little crazier everywhere else. It's flipped. Now it looks like U.S. policy is very much up in the air. Nobody really knows what's going to happen. I've told you what I think is going to happen, but I think the market is still waiting to see how things are going to pan out. We've seen a lot more decisiveness and certainty, whether you think it's the right or wrong thing to do, in places like Europe and China. Those two things together have led to this huge move in the political uncertainty index. And you can see that over the last 15 years, it does track. It's not perfect, but it tracks the U.S. dollar index fairly closely. If you're going to take this chart literally, I don't take it completely literally, but if you look at this chart, you say, this is not good news for the U.S. dollar index. If you believe this chart, the U.S. dollar is going to get a fair amount to fall. Like I said, I don't take it that literally, but I think the basic message of it is probably true. I think the combination of that, continued comments from the FOMC that we need more fiscal, but more to the point, them, I think, doing monetary stimulus, you'll see them come into the market again fairly quickly if it doesn't happen. I mean, and I think you've seen this already affect the market. I mean, one thing that's been interesting, and a lot would say odd, in the last 2 or 3 months is how strong the euro and the Chinese yuan have been in comparison to the US dollar. I mean, if you looked at the US economy, I mean, China came through this whole thing first, so they're in better shape, but certainly the EU isn't. The EU's a mess. But the euro's been surprisingly strong. And I think this is a measure of what traders in the currency market think is going to happen to yields in these different areas. Because normally currency cross rates are very closely correlated to what currency traders think the margin is going to be between real interest rates in different currency blocks. So if you think that the real interest rates between the US and the euro are going to get closer, that's going to strengthen the euro. I think we're seeing that now. And I think now that things have really gotten haywire in the last week after this election, we're seeing another down move. I mean, there was a bit of a lift sort of September, October, obviously the same time the yields were going up. It dropped off again. We saw another bounce before the election because I think, again, they're expecting that, blue wave, tons of fiscal spending, economy accelerates. That's kind of gone out the window. In the last few days, there's been a big drop in the US dollar. It's close to its October lows now. If it cuts through those, I think there's probably room for it to go a lot lower, which surprises me a little bit, honestly. I'm surprised how weak the US dollar is. And the one caveat I would add to this, although it hasn't impacted things yet, there's a massive short position on the US dollar. It's huge. I don't know how the unwind of that position is going to affect things because I don't know why everybody put those shorts on. If they're straight trading, then yeah, there's always going to be potential in the next little while for essentially a short covering rally where the US dollar goes up like a cent or a cent and a half. I'm not sure that's the case, so I suspect a lot of these US dollar shorts are probably hedges against other positions, and they may just let them fall off at the end of the contract period rather than try to buy them back. I mean, we're going to have to see, but so far it's worth noting that they really haven't impacted it much. So where does this get us to at the end of all of this? Party split between Congress, Senate, and the White House. I don't think we're going to see it. The nearest time we would see at this point, I think a large fiscal package would be at least late January. I'm assuming Trump is not going to be the winner of the election. I don't think he'll care about trying to push a. He was pushing a fiscal package 2 weeks ago because he was trying to get elected. I don't think he cares otherwise, to be honest and cynical about it. I think the Republicans are going to do everything they can to make things difficult for the Democrats. Keep in mind that if you're a U.S. senator or a U.S. congressperson, you're not thinking in 4-year election cycles. You think in 2 years, which basically means, war horses like Mitch McConnell, they start thinking about the next election the day after the last one's over. That's how they operate. And I think in his mind, he's going to say, excuse my French, whatever's going to fuck the Democrats up the most, that's what I'm going to do. If holding this package off is going to mess them up because it'll hurt the economy, great. That's where we're going to go. So, I mean, I hope I'm wrong. I hope we do see a fiscal package that kind of smooths things out over the next couple of months. But I'm honestly, my strong feeling is that we don't see a fiscal package soon, and that we may not see a large fiscal package. Period. It simply doesn't get through the Senate and never gets voted on. So that we're going to have to wait and see what happens as we get into late Q4, early Q1. I think without this package, you're going to see the U.S. economy decelerate. Certainly in relation to other economies that are already kind of sketchy. That's not going to do. I don't think that's going to do the U.S. dollar any favors. I think that's going to bring the Fed back in. They'll be back. They'll be back buying up bonds, everywhere in sight. I think you're going to see probably, it may not happen this month, but next month, I think we start seeing unemployment tick up again because a lot of people that were held onto their jobs were there because of these PPE programs and stuff, and those are all gone now. So I think there's a real chance we'll see growth drop, unemployment go up. Certainly there's going to be a huge unemployment rate for political pollsters. They're probably all out of work as of today. So I think with all those things together, I think that it looks like that's enough. And certainly if today's anything to go by, and yes, it was lucky I picked today to put the slide on, it looks like gold is fairly strongly and convincingly breaking the mild downtrend it's been in for the last 3 months. I wasn't that worried about the gold price, but everybody else seemed to be. And certainly based on where it's trading right now, if that's where it closes, we've broken that downtrend. And I think that by itself is going to give us some upside. The other thing that I'll point out, and this is more about the stocks than the gold price, people being very frustrated at the way junior's been trading for the last 2 or 3 months. A lot of that is just the gold price. But the other thing you have to understand, and I can tell you this because I wrote plenty of checks myself, May, June, July, there was a massive amount of financings in the junior space. huge placements everywhere across the board, billions of dollars. All of those things, almost all of those are free trading now. In most cases, traders that bought those placements are up 200, 300, 400%. And in a lot of cases, those traders are basically tapped out. They wrote check, if they were bullish on the sector, they basically cleaned themselves out, writing checks left, right, and center where they could. You're seeing a combination of just straight up profit taking, where they're up 300 or 400%, so they're taking some money off the table. Added to that, I think you're also seeing traders saying, I want to write more checks because I think we're going to get a bounce here soon. But in order to do that, I got to sell some stuff. That's what's been going on for the last couple of months. We should be pretty close to the end of that, and it felt like we were on a lot of stocks I followed because the volume had really tailed off. So I'm hoping that combination of things, plus finally starting to see some assays, especially from the northern hemisphere projects, where the lab situation's been really ugly. But we should start seeing these things coming in the next 2 or 3 weeks. I think that's a good combination. I think we're now going to have the traditional autumn rally, even though it's not autumn anymore. I think we're finally going to get that probably between now and Christmas, and I'm hoping, fingers crossed, that it's just going to keep going as it does some years right into January. But I think we're about to have a little more fun than we had before.